Imagine discovering how a single decision from the Federal Reserve could make or break your Bitcoin investments. What if the next rate change sends BTC soaring or crashing? Today, in February 2026, with Bitcoin trading around $67,000 amid steady U.S. interest rates, we're exploring exactly how these rates shape Bitcoin's price. Stick around for data-driven insights from top sources that could protect your portfolio. For 100% true news and correct advice like this, like the video, subscribe to Joseph Markets and comment Joseph Markets below. It helps deliver more verified finance content. By the end, you'll understand the mechanisms, history, and future outlook. But first, the basics. Key points. Research suggests that U.S. interest rates have a generally inverse relationship with Bitcoin prices, where higher rates tend to suppress BTC due to reduced liquidity and risk appetite, while lower rates often boost it by encouraging investment in speculative assets. It seems likely that while Bitcoin is sensitive to Fed policies, other factors like market sentiment and regulatory changes also play significant roles, leading to volatility around FOMC announcements. The evidence leans toward Bitcoin behaving more like a risk asset correlated with stocks rather than a pure inflation hedge, with historical data showing sharp drops during rate hike cycles and rallies during cuts. Investors should approach with caution, as predictions for 2026 vary widely amid steady rates, but potential dovish shifts could support upside. Understanding the relationship U.S. interest rates, set by the Federal Reserve, influence borrowing costs, economic growth, and investor behavior. When rates rise, money becomes expensive, pulling capital towards safe assets like bonds and away from volatile ones like Bitcoin. Lower rates do the opposite, flooding markets with cheap money that often flows into crypto. This dynamic has played out repeatedly, making Fed decisions a key driver for BTC prices. Historical context. From the 2022 bear market crash amid aggressive rate hikes to the 2023-2024 recovery during cuts, Bitcoin's price movements underscore its ties to monetary policy. In 2026, with rates paused at 3.5%, 3.75%, BTC hovers around $67,000, $68,000, down from 2025 highs, reflecting caution over future policy. Investment implications. For everyday U.S. investors, monitoring Fed signals like FOMC minutes and economic data, e.g., CPI, unemployment, is crucial. Diversify portfolios, as while lower rates may lift BTC, unexpected hikes could trigger sell-offs. Long-term, Bitcoin's scarcity could enhance its appeal if rates remain accommodative. What are U.S. interest rates and how do they work? U.S. interest rates, primarily the federal funds rate set by the Federal Reserve, Fed, determine the cost of borrowing money overnight between banks. This benchmark influences everything from mortgages to business loans. The Fed adjusts it through the Federal Open Market Committee, FOMC, to manage inflation and employment, raising rates to cool an overheating economy, lowering them to stimulate growth. According to the Federal Reserve's official site, the funds rate targets inflation at 2% and maximum employment. In 2026, the rate stands at 3.5%, 3.75%, paused after 6 cuts since September 2024, reflecting a balanced but cautious economy with inflation above 2% and slowing jobs. This stability affects Bitcoin by maintaining moderate liquidity, neither flooding nor starving markets. Higher rates make safe assets like bonds attractive, pulling money from riskier plays like BTC. Lower rates do the reverse, encouraging speculation. According to Bankrate, higher rates slow economic activity, shifting investors from volatile crypto to safer options. Practically, when rates rise, borrowing costs spike, businesses cut spending, and consumers save more, reducing overall money flow into assets like Bitcoin. This risk-off environment often tanks BTC prices. Conversely, rate cuts inject liquidity, boosting risk-on sentiment where investors chase high returns in crypto. For U.S. viewers, this means Fed announcements can swing your 401k or crypto wallet overnight. But how exactly? Next, we'll dive into the direct mechanisms. Stay tuned, as this could change your trading strategy. How have rate changes affected your investments? Comment below, and for more real insights, like, subscribe, and say, Joseph Markets. Mechanism 1. Liquidity flow and credit. Availability. Liquidity is the lifeblood of markets, the ease of buying, selling assets without price swings. When the Fed hikes rates, borrowing gets expensive, credit tightens, and liquidity dries up. Investors sell risky assets like Bitcoin to cover costs or seek safety, pressuring prices downward. According to Crypto.com, crypto thrives in easy money environments. High rates dry up liquidity. Historical proof. In 2022, the Fed's 11 rate hikes from near zero to over 5% triggered a crypto winter, with Bitcoin crashing 65% from $69,000 to $16,000. Tight credit meant less speculation, amplifying sell-offs. According to CoinLedger, high rates make investors less likely to pursue crypto. Conversely, 2020's rate cuts to near zero amid COVID flooded markets with $4 trillion in stimulus, fueling Bitcoin's 590% surge to $69,000. Cheap money encouraged borrowing for investments. According to S&P Global, QE in 2020 correlated with Bitcoin's 1,000% gain. In 2026, with rates steady, liquidity is moderate. ETF outflows of $8.5 billion since October 2025 reflect caution, keeping Bitcoin range-bound at $65,000, $72,000. According to VanEck, deleveraging reduced open interest by 20%. If the Fed cuts further, liquidity could spike, potentially pushing BTC to $100,000 plus as predicted by some. According to CNBC, lower rates could support $175,000 by year-end. This mechanism explains why FOMC days see 2 to 5% BTC volatility. Traders bet on liquidity shifts. For you, monitor Fed balance sheet. Expansion, QE, boosts crypto. Contraction, QT, hurts. But there's more. Opportunity costs, next. Mechanism 2. Opportunity cost and yield-seeking behavior. Opportunity cost is what you forgo by choosing one investment over another. Low rates make bonds yield little, so investors reach for yield in high-risk assets like Bitcoin. High rates boost bond yields, making them competitive, drawing capital from crypto. According to NewHedge, low rates increase risk appetite, lifting Bitcoin. High rates do the opposite. Example: post-2023 rate peaks. Cuts began, yields fell, and Bitcoin rallied 687% to $126,000 by 2025. Investors fled low-yield bonds for crypto's potential. According to Bankrate, prices rose in 2023-2024 as rates topped and declined. But in late 2025, despite 3 cuts, Bitcoin fell 45% as yields stabilized and precious metals surged. According to Forbes, December 2025's cut pushed BTC to $94,000 briefly, but gains faded on unclear future cuts. Currently, 10-year Treasury yields hover around 4%, offering decent returns without crypto's volatility. This has capped Bitcoin's upside in 2026, with prices down to $67,000. According to Charles Schwab, interest rates impact BTC's short-term price via yields. Studies show Bitcoin's correlation with 10-year yields at 0.33 since 2017, inverse 75% of the time post-2020. According to S&P Global, rolling correlations confirm this. For retail investors, this means diversifying. In high-rate eras, favor bonds, low-rate times, allocate to BTC. But USD strength adds another layer. Let's explore. You won't believe how the dollar ties into this. Like and subscribe to Joseph Markets for more. Comment, Joseph Markets. Mechanism 3. USD strength and capital movement. Higher U.S. rates attract foreign capital, strengthening the USD, making dollar-priced Bitcoin costlier for global buyers, reducing demand. Lower rates weaken the USD, cheapening BTC internationally, boosting adoption. According to CoinLedger, reduced rates weaken the USD, making Bitcoin attractive as a store of value. Case in point, 2022's hikes strengthened the USD index to 114, coinciding with Bitcoin's plunge. Emerging market outflows exacerbated this. According to Crypto.com, high rates strengthen USD, hurting crypto. In contrast, 2020-2021's low rates weakened USD to 89, aiding Bitcoin's global rally. According to WazirX, rate cuts increase liquidity, weakening USD and supporting BTC. In February 2026, the USD is bearish per surveys, with record short positions, potentially bullish for Bitcoin if it slides further. According to CoinDesk, bearish USD bets could lift BTC as a risk asset. But if a short squeeze rebounds USD, BTC might dip. Predictions. A dovish Fed could weaken USD, targeting $150,000 BTC by year-end. According to Yahoo Finance, further cuts could trigger inflows. Global investors, 60% of BTC holders, amplify this. Rate differentials with Europe, Japan matter. According to Investopedia, Fed cuts in 2025 helped BTC briefly, but unclear outlook capped gains. This global angle is key for U.S. targeted strategies. Mechanism. 4. Discount rate and valuation of risky assets. Higher rates discount future cash flows more steeply, lowering valuations of growth-oriented assets like Bitcoin, seen as a long-term store of value. Lower rates inflate present values, supporting higher prices. According to Crypto.com, high rates make future growth less attractive for crypto. Illustration. 2022's rate surge from 0.25% to 5.5% halved Bitcoin's valuation, contributing to the 65% drop. According to The Motley Fool, Bitcoin fell 65% as rates rose. Post-cuts in 2023, valuations rebounded, with BTC hitting $126,000. According to CoinLedger, long-term cuts favor crypto via liquidity. Today, steady rates keep valuations compressed, with Bitcoin's price-to-mining cost ratio low. According to MUFG, BTC trades below $87,000 mining cost. If rates fall to 2 to 3%, analysts see $175,000. According to CNBC, institutional adoption plus cuts could hit $175K. Academic studies confirm FOMC pre-announcement drifts lift BTC 0.96%, but day of drops 1%. According to Science Direct, announcements cause 0.26% average rise, but volatile. This valuation lens helps predict bubbles or bottoms. Ready for history lessons? Comment your BTC prediction, like, subscribe, Joseph Markets. Historical cycle. 1. The 2020-2021 boom amid low rates. With rates near zero and 4 TQE, Bitcoin exploded from 10K to 69K, plus 590%. Cheap money fueled retail institutional buys like MicroStrategy's billions. According to S&P Global, QE correlated with 1,000% gain. Halving tightened supply amid liquidity flood. According to Bankrate, low rates boosted risk assets. Details. CPI rose to 7%, but BTC hedged it, outperforming gold. Correlations with stocks hit 0.68. According to Investing.com, Nasdaq correlation amplified moves. Post-March 2020 cut, initial 39% crash rebounded as stimulus hit. According to CoinLedger, volatility followed cuts. For 2026, similar dovish Fed, e.g. Warsh nomination, could repeat if cuts resume. According to Reuters, nominee adds uncertainty. Historical cycle. 2. The 2022 bear market. During rate hikes, Fed's hikes to combat 9% inflation tanked BTC 65% to 16K. Tightening via QT withdrew liquidity, with M2 growth negative. According to S&P Global, QT led to bearish periods. Idiosyncratic events like FTX worsened it. According to VanEck, miners sold amid financing crunch. Breakdown. Inverse rate correlation peaked, with BTC down as yields up. According to NewHedge, high rates dropped risk tolerance. Recovery started as hikes paused. Lesson. Avoid leverage in hike cycles. According to WazirX, hikes impact volatility sharply. Historical cycle. 3. Recovery in 2023-2025 with rate cuts. Cuts from 5.5% sparked 687% rally to 126K. ETFs brought billions. According to Bloomberg, inflows boosted adoption. But late 2025 pause and outflows dropped at 45%. According to Daily Forex, 6B outflows in months. December 2025's cut briefly hit 94K. According to Forbes, speculation fueled 5% gain. In 2026, paused cuts keep pressure, but dovish signals could rally. According to CNBC, 75K, 225K range. Expert opinions and predictions for 2026. Kathy Wood, 150K plus with cuts, according to CoinDesk, dovish Fed lifts. Standard Chartered, 100K, according to Investopedia, recalibrated lower. Maple Finance, 175K on adoption cuts, according to CNBC institutional drives. Bearish, if no cuts 50K, according to DL News, bubble warns. Surveys, bearish USD bullish for BTC, according to CoinDesk record shorts. Future outlook and strategies. If cuts resume, 110K, 140K, according to AI Invest, liquidity expands. Risks, stagflation drops, according to investing.com, macro hurts. Strategies, DCA, diversify, watch FOMC, according to KuCoin, fundamentals intact. There you have it, how US rates drive Bitcoin. Like, subscribe Joseph Markets, comment Joseph Markets.